Corporate finance practice problem using Excel. Bond purchase on margin and then sold. Get ready, it's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab in essence being an answer key. Information on the left-hand side, we're going to populate that into the blue area on the right-hand side. We're going to say that the bond was issued at a par value of $1,000, coupon rate 9%, years to maturity 20. We're imagining that bond having been purchased at a price of $1,050, so purchased at a premium. The paid cash of 20%, so only 20% was paid of the $1,050 purchase price because the rest was bought on margin, in other words, borrowed. There was a borrowing of the 80% in order to pay the rest of the price. So then the interest payments on the bond are used to pay off the interest on the loan. So basically we got then the money, 20%, the actual cash from the investor, the other 80% through a loan. Then we've got to basically pay off the loan. We're going to do so then with the interest from the bond that we're going to be receiving. We're going to be receiving the interest payments, pay off the loan, and then we're going to realize the price of the loan at the point in time that we sell it. So then we're going to imagine that we sell the loan and the market rate at the point in time of sale is 8%. Okay, so let's think about the current bond price. So we're imagining we're in a situation where we're holding on to this bond that we financed, 80% of it paid 20% in cash. We're now going to sell it when the market rate is at this 8%. So let's calculate the current bond price that we imagine that we're going to sell this thing at. So we'll do this with our Excel calculation. We're going to say this is the present value of the interest. Note that we go into this type of calculation, estimating the bond price in a lot more detail in a prior section. So if you want to go through that in multiple problems in more detail, take a look at that section. We'll go through it a little bit more quickly here. Also note, if you need to look at the present value calculations, take a look at a prior section where we focus specifically on them. So this is going to be negative present value, shift 9. The rate is the market rate, which we're now saying is the 8%, comma. Number of periods is going to be 20 at this point. We're going to say comma, and then the interest payments are going to be the 1,000 times the coupon rate of the 9%. So that's going to be the value of the annuity. Let's add some decimals, numbers group, couple decimals. Then we'll pick up the present value of the principal, which is going to be the present value of this $1,000. So negative present value, shift 9. The rate, market rate, once again down here, which is the 8%, comma. Number of periods is going to be 20, comma, comma, picking up then the future value, 2 commas because it's not an annuity, but present value of 1, the future value being that 1,000 that we bring back. Adding some decimals there, number group, couple decimals. That gives us the price calculation, the price of bonds, which is equal to the sum of the 883 and the 214.55. Adding some decimals, number group, couple decimals, that's the 1,098.18. Underline under the 214.55, font group, and the underline. So now we're going to calculate the dollar profit based on the current price. So if we sell it then, in other words, for this 1,098.18, what was going to be our profit? Well, we bought it for $1,050, even though we financed part of it and really only paid cash of the 20%. Let's just first think about our profit in total. So if we had the price of bonds, or let's say sales price. Let's call this sales price. Sales price is going to be what we just calculated, 1,098. Adding some decimals, number group, couple decimals, and we purchase price. So the purchase, let's call this purchase cost. Let's call that the cost. And that's going to be the 1,050. That's what we bought it for. Number group, adding a couple decimals, font group, underlining it. That's going to give us our profit. So the profit is then going to be equal to what we sold it for minus what we bought it for. And let's add some decimals there. Number group, couple decimals. So we got 48.18. If we look at the margin there, if we take a look at the profit divided by the sales price of the bonds, making that a percent, numbers group, and percentifying that, adding a couple decimals, we've got basically a profit margin of that 4.39%. But let's think about the situation. What's the profit compared to the cash that we actually put down on the bond? So let's first think about the amount paid in cash. So a calculation of the amount that we paid in cash. We had the price of the bond, which was the 1,050. I'm going to put this on the inside. 1,050, and we paid cash 20% of it. So this is the percent. Let's do it this way. Percent paid in cash was 20% equals the 20%, making that a percent by going to the number group, percent define it, underline, font group, and underline. That's going to give us the paid in cash amount, which is going to be equal to the 1,050 times the 20%. So we actually only paid 210. We're going to say numbers, adding a couple decimals. The difference between that and the purchase price we financed the other 80%. In other words, if we compare that cash that we paid to the profit that we had, which was the 4818, making that a percent numbers group, a percent. And then we will underline that. That'll give us the, let's call it the percent return on cash investment. Percent return on the cash investment, which is going to be equal to the profit divided by the cash that we had to put down. And then we're going to go up top and say numbers and make that a percent and add a couple decimals. So then if we compare this then to what actual cash we put down because we financed the 80%, now we're looking at the percent return based on or compared to the cash that we had to put down in order to facilitate the transaction. We have the 22.94 as compared to the profit margin of the 4.39, or you can imagine a situation that if we put all cash down, paid for it in cash, then we'd have the profit margin of a 4.39 as opposed to us financing it at the 22.94. Now, of course, that is beneficial due to the fact that there was an increase, there was a gain. So buying on the margin could amplify then the gains. If there's a loss, then of course it wouldn't work out favorably for us. But if it's a gain, then it could work out favorably for us in that situation.